Hello everyone, hope you're doing okay. This is Raz Capital with a trading process video. Friendly reminder, this is not investment advice and it is for educational purposes only. Alright, so today we're looking at Take-Two Interactive Software. I started getting interested in this trade around May 18th. Nevertheless, it had earnings on May 20th. Generally speaking, I don't like taking setups before earnings because that does not give me enough time to have a profit cushion if it goes the other way. And so what I like to do is generally wait after the earnings report to look for a high risk reward entry. So if we take a step back and look at the weekly chart on Take-Two, we see it's basically been consolidating for about 2 years, from January, give or take, 2018 up until now, June 2020. What I think is of utmost importance when analyzing a trade is stage analysis. Authors like Sam Weinstein or Mark Minervini go into the stage analysis in their books, which will be in the recommended reading list if you want to check that out with a little more detail. But looking at the weekly chart, zooming out a little bit, we've seen this has basically gone nowhere for 2 years, which is fine, which could be categorized as a stage 1 base, a stage 1 flat base, with the 134 level being of interest. So Take-Two broke out around May 18th before earnings on very good volume, very good accumulation volume, which is suggesting institutional sponsorship. This is the kind of trades you want to be in because you want that muscle, you want that money flow from the big hedge funds, trading desks around the world to keep on buying the name and moving the price up. So it reports very good earnings, which we'll get into in a moment, and it's been pulling back nicely. If we look at it from May 21st, volume has been decreasing while price has been finding support around the moving averages. I like to use the 20-day moving average as a short-term moving average, the 50 in pink as an intermediate moving average, and a longer-term moving average, the yellow one, which is the 200 MA. So right now, I took a position. I wanted to show you that you don't have to buy at the absolute bottom. I bought this day on June 2nd at the close. I liked it because this hammer at the 20 MA is signaling some sort of support at these levels, and coincidentally it's just at the flat base pivot at 134 level, which is the white line. So I took the trade on June 2nd at a risk reward that looks very favorable by placing my stop 13% below. Why did I choose that level for my stop placement? Because it's below this prior low and below all three moving averages. Obviously, my trade thesis would be invalidated if it broke this low and is trading below, especially the longer term 200-day moving average. I am a fundamental trend follower, so I like my long trades to be above the 200 moving average with improving fundamentals, and my shorts to be below the 200-day moving average with deteriorating fundamentals. So right now, let me zoom out and let me get my trade analysis. I highly recommend, especially starting traders, that you analyze every single trade you take and put it in a trading journal. I like to take screenshots of my trades with this sort of analysis and paste it in an Excel sheet. That way I can review past winning trades and see what I did correctly, and most importantly, review past losing trades and see what I could have done better. It's important to make a difference. A good trade is the one that you followed your process, your trading rules, and a bad trade, regardless of the outcome, is the one that you did not follow your rules. So this is the type of trade that I'm following all my rules, and it may go sour. It may go the other way. That doesn't make it a bad trade. Bad trade would be if I broke any of my rules taking this setup. So I'm looking at this in tradingview.com. The red gives the trader an idea where his stop loss is, which in my case is this 116.69 level. The gray area is your entry point, which in my case is also 134.19, and the green is your ideal profit target. So once I take a trade, I like, because I use wide stops improve your system's reliability and you avoid getting whiplash. And obviously if you're using wider stops, your position size has to be smaller. We'll get into a position size video later on, but everything has a price. And if I'm using wider stops, I like to take my first half off at 2 risk reward, which in this case would be the 169.30 level, and let the other half run. So I like to get in my trades, set an appropriate stop loss level with good position sizing, scale half off at 2 risk reward, and just trail it with my stop using, most of all in uptrends, the 200 MA and the 50 MA as my guides. So alright, let's get into the trade analysis, which I put on my trading journal. It's a stage 1 looking to transition into stage 2. Like I said, there are authors covering this. Stage 1 is the accumulation phase, the consolidation phase, and stage 2 is the accumulation phase. Stage 2 practically is an upsloping 200-day moving average, which is telling the trader that there is broad institutional participation, and those are the type of stocks that you want to be in. As I said, as the 2-year flat base is broken on heavy volume, pullback setup to 133.36 base, pivot on a 20 moving average, support on light volume, like we said in the beginning of the video, with 13% stop loss below all moving averages, prior correction lows, and 9-week lows. This has a relative strength rating of 87 and an industry rank of 18. So Sam Weinstein in his book also goes into this in detail, that we want to belong the strongest relative strength names, which signifies that they're performing, the name is performing against the market, and strong industry groups, because you can have a beautiful setup, but if it's in a lagging industry group, the trade may go nowhere. Some authors even suggest that 70% of the move of a stock is due to the industry group and sector. And as I said, it reported very good fundamentals on May 20th with a 114% increase in EPS, earnings per share. With regard to the prior quarter a year before, it has minus 4% 3-year EPS, plus 11% EPS estimated for the year. Return on equity is 17.7%, plus 41% sales last quarter, plus 24% 3-year sales, 0% debt, 8.7% annual pre-tax margin. Management owns 1.2%. So basically, I like to look for trades that all metrics are above 25% and preferably no debt. So in this case, it's very strong overall. The company has no debt, and the only negative metric is the 3-year EPS. On an ideal situation, everything would be beautiful above that 25% mark, but as traders, we have to be flexible, and perfect setups don't always emerge. Let's put it that way. So guys, I hope you enjoyed this video, this trading process video. I wanted to share a position I'm currently in with an open P&L, so we can track it together on a day-by-day, week-by-week, or monthly basis. My regular holding time is around 3 months or more, so it may take a while. And if you like these type of videos, please hit the like button, and be sure to check out our Instagram page and website for more content on trading. Hope all of you are doing very well, and have a nice day.